Building an investment portfolio can seem overwhelming, especially if you're unsure where to start. But here's the truth. A well-structured portfolio isn't just about picking stocks or funds. It's about creating balance and minimizing risk through diversification. In this video, I will guide you step by step on how to build a strong investment portfolio, from understanding asset classes to spreading risk across different sectors and markets. You will learn why diversification is the cornerstone of successful investing. Ready to take control of your financial future? Let's get started. So you have two big rules when it comes to investing. First rule is you need to invest according to the time horizon. This is one of the biggest mistakes people do when they start investing. So first of all, according to the time horizon, we have the first time horizon, let's say 0 to 3 years. So let's say you save money from 6 months to 3 years, for example. Okay, at that point, you take out a Tagesgeldkonto. Another name would be, or another option would be fixed deposit. Tagesgeldkonto is liquid, so you can take that money out anytime. And fixed deposit, yeah, as the name already mentions, is fixed. So for, let's say, 1 year or 1.5 years, you typically have higher interest rates if you take a fixed deposit. If you prefer flexibility, you can just take a Tagesgeldkonto. Currently, they pay 2.5 to 3.5%. It depends on how high the European Central Bank interest rate is. This is really important. Why do we only take, well, such a low interest amount over 0 to 3 years? It's because of fluctuation. If you invest in the stock market, it might be the case that the stocks go up over 2 years. It might be the case that the stocks go down over 2 years. The problem is now, if you need the money in 2 years because you would like to buy property, well, then you have to sell the stocks, or you have to wait another year maybe until the stock market is recovering. So it's really risky to invest in stocks, for example, or also ETFs if it's short term. Okay. If we consider a medium-term investment, so let's assume 3 to 7 years. So maybe you would like to save money for a bigger house purchase. So you have more time because you need more money to actually save that amount, especially if we talk about properties in Munich, for example. You typically need more time to save a certain amount. So if you save money over 3 to 7 years, then we should consider bonds, also called multi-asset funds. Multi-asset fund would be a mutual fund which invests in stocks, commodities like gold, for example, and also bonds. So it's not like a full stock investment, but it's a partial stock investment to balance out risks. If you invest longer than 7 years, well, then you just go for ETFs and mutual funds. I'm always a big fan of calculating conservatively, so 6 to 9% profit per year. I know that the profits currently are significantly higher, but let's calculate conservatively also on an average basis that you generate 6 to 9% per year here. If we have time longer than 7 years, then even if we have fluctuation, it's not a big problem because we just have enough time so the market recovers and we have long-term high profits. If you save money for retirement, which should be at least 12 years, then you can also go for probably primarily ETFs, maybe some mutual funds, which also obviously generate 6 to 9% per year. It should be done differently than a typical mutual fund investment. Here, you should probably consider a pension plan just because you have significantly better tax benefits if you go for a pension plan, but this is a topic for another video maybe. So this is rule 1. You need to invest according to your time horizon. So first of all, it's really important to understand what do you actually want, when do you need a certain amount of money, and then you can plan accordingly. Second rule is diversification. Also, one really common mistake that people only invest in one country, in one currency, in one industry, or even worse, only in one company if the majority of one's asset is into the company stock they're working for. Okay? So be really careful here. There are so many examples where you lost a lot of money. Obviously, it sometimes works, but it's more luck and less that you have a strategic approach behind. Okay? So this is diversification. If you keep these two rules in mind, that you invest according to the time horizon, plus you diversify your portfolio properly, it's more or less impossible to lose any money. It's more the opposite. You actually have the certainty that you will generate profits, especially over a certain time horizon. It might be the case if you invest in stocks that you are in loss in over 2 years. Might be the case, depends on what's happening in the world. But over 7+ years, there is more or less no time horizon in historically that you lost any money if you're investing for longer than 7 years. Okay? So that's, let's say these are the basics, 2 rules. Let me now show you something else. 1 second. So first of all, you see the diversification when it comes to countries. This is a sample portfolio of a medium-term investment. Okay, so we see 34% investments in the US. Well, this is typically the most interesting market, at least for the time being. 10.9% would be German companies. Maybe you're surprised, but actually in the last 12 months, the DAX, so the 40 biggest companies in Germany, performed better than the S&P 500, so 500 big companies in US, actually. Because we have really interesting companies in Germany like Siemens, SAP, Telekom. These are really interesting companies which still make huge profits. 7.2% Japan, obviously companies like Toyota are interesting. Companies in France, Australia, Great Britain, Canada, and so on. So you see we have a pretty broad diversification here. On the other hand, you see medium-term portfolio, so we don't invest everything in stocks. Only 65% is invested in the stock market itself. 27% would be invested in bonds to have more security, since we are talking about a medium-term investment. Now you see the diversification when it comes to industries. So 18% would be IT and technology, 12% finances, so investments in banks, for example. 8.9% consumer goods, healthcare, industry, energy, raw materials, and so on. And also here you see the largest position. This is a bond from the US government with the highest position of 1.89%. Second biggest position would be Microsoft, and we have Apple, Taiwan Semiconductors, Nvidia, and so on. So you see we have a good diversification also when it comes to the specific stocks or bonds. So you don't invest too much into one company, for example, to outsource any or to avoid any risks here. So if we now look at the performance, we see in the medium-term portfolio over 5 years, annual profit rate on average over 5 years would be 8%. How do we achieve 8% with a more conservative portfolio while we are avoiding any risks? This is important to say here. So you see that actually most of the investment is invested more defensively. So we have here 3.46, 5.3, 4.4, 3.5, 4.8. But we include 2 multi-asset funds that invest primarily in stocks, or we can also include at least 2 funds which are investing fully in stocks. You see that here, that 20% would be one fund which is investing in stocks, and we have another 15% which is also investing, especially here, more offensively. So in the end, 35% is actually invested more offensively, while 65% is invested more defensively. So in the end, we can still generate 8% interest without taking any risks, which might be a suitable portfolio for a medium-term time horizon, or if you're just more a defensive investor in general. Here we also see why it's so important to invest according to the time horizon, because this mutual fund performed really well. We have 17% plus over 5 years. However, in 2022, this mutual fund had a loss of 21%. So if you invest it, or you have invested in that fund in 2022, and you need that money after 1 year, you would actually have lost 21%, but over 5 years, you would have a profit of 17% per year. Okay? So really, really important to invest according to time horizon. Let me show you another option. This would be, let's say, a more offensive portfolio. So you see 50% in US, so we already have a cluster risk. We should be careful here. Then you should be actually willing to take higher risks here, because 50% in one country is a cluster risk. It might make sense because it's US, but just to mention that it's riskier. We have 8.6% Germany, Japan, Great Britain, Switzerland, and so on. Here you see that most of the money is actually invested in stocks, 91%, so it should be invested for at least 7 years. We also have a bigger cluster risk here because roughly 24% is invested in IT and technology. This is also riskier because you have a higher cluster risk, but should be fine since it's the IT and tech sector. Largest position again, this is a bond. There we have Microsoft, Apple, Procter & Gamble, and Nvidia. So if we now look at the performance over 5 years, we see we would generate 11.48% profit per year, while we have a really, really good diversification. So it's again mentioned here, 2022 was not a good year in the stock market. So if you invest primarily in stocks, as mentioned here, you will have a loss of 16% in 1 year. Is this now a bad investment? No, it's just normal. It might be the case over 1 year. So if we look at it over 5 years, we would have a performance of 11.48. And in 2021, we actually had 30% plus in 1 year. So just because you made 30% plus in 1 year doesn't mean it's a great investment, because it might be the case next year that you have minus 16%. The only thing which is really important is how much profits do you generate over a certain time horizon, which you have set up front. So if you say you want to make the most money in liquid assets over 7 years without taking huge risks, well, then this is the right investment here. I mean, you still have some fluctuation because most of the money in US plus IT and tech, but in general, it's fine. So then this would be a suitable investment. But if you say you want to generate the most profits over 3 years, then this is not the correct investment. Okay, even if you might be the same personality, same risk appetite, same situation, the only difference is time horizon, then this investment wouldn't be suitable here. And there you have it, a roadmap to building a diversified investment portfolio that balances risk and rewards. By spreading your investments across different assets, sectors, and markets, you're not just protecting yourself from volatility, you're setting yourself up for long-term success. If you found this video helpful, make sure to like and subscribe for more tips on investing, financial planning, and growing your wealth. And share your thoughts in the comments. How are you diversifying your portfolio? Or what's your biggest challenge in getting started? Thanks for watching, and remember, diversification isn't just a strategy, it's your safety net in the world of investing. See you in the next video.